Okay, it is thankfully 1 o'clock, so we can get started. I don't know what I did, but I turned this thing on 10 minutes early, which is very awkward, which is why me being alone in the office doing this by myself is not a good idea. But anyway, we'll get started. So my name is Mark LaMonica. I look after the individual investor team in Sydney for Morningstar. And today we're going to talk about value investing and sort of take a little look at value versus growth. And yeah, hopefully it should be exciting. So a couple of things, the housekeeping items. So number one, anything you hear today is general advice. I don't know anything about you, so I can't offer any personal advice. For our friends over in New Zealand, if you want a copy of our FAP, you can go to our website, morningstar.com.au, and get a copy of that. And then, of course, for if you do want personal advice, you should go see a financial advisor. And the other thing is, even though I can't offer personal advice, I would love questions. It makes it more interesting for me, and that's what we're all here for. So, so let's get started. Okay, so talking value versus growth, but we'll start with value. So what is value investing? So we hear value investing a lot. We hear the term a lot. And basically, if we sit there and we look at value versus growth, one way to think about it, of course, is just going through and dividing up stocks into two different categories. And there we go. Here are a number, and different people measure this in different ways. What I did is I went and I looked at all of the criteria that goes into the Morningstar style box. If anyone has seen the Morningstar style box, that allows you to plot a individual share or a fund or an ETF, or we plot it for you. It allows you to see where it plots on a value versus growth continuum and a market cap. So basically size of companies, from small cap, smaller stocks, to large cap, large stocks. So these are the different criteria that go into ranking stocks between value and growth. So as you can see, we've got a number of different valuation techniques. So everything from price to earnings, so that's how much we're paying for earnings as an investor, price to book, price to sales, price to cash flow. So we can rank stocks on those different measures. We can also, of course, look at projected and historical growth in earnings and sales, cash flow, book value, etc. So one thing that's very important to remember is that when we say holistically, when we're looking at the S&P 500, for example, and we're talking about value versus growth, there is no judgment involved in this. This is ranking stocks of where they fall. So there's not a particular number. There's not a P of 10, and anything below 10 happens to be a value stock, and anything over 10 is a growth stock. All we're doing is dividing up that universe and ranking them. So if the market's really, really expensive, that means that value stocks will be potentially historically expensive. If the market's really, really cheap, then growth stocks could be historically cheap, but all we're doing is ranking them. So it's something important to remember. The other thing that's important to remember, which is why we have this Eagles reference here, the Hotel California, is unlike the Hotel California, you can leave. So you can be a value stock that turns into a growth stock and vice versa. So obviously, as these different metrics change, you can go back and forth between the two. So that's something important to remember as well. Now, there are, of course, certain industries, and we'll get into this as we go through this, there are certain industries that generally would fall into one of these two different categories. And that really goes with what investors are actually willing to pay for earnings, for example, for the different attributes of a share. And we'll get into some of that. But just know that technically you can leave and you can move into one or the other category. All right, why are we talking about this today? Why do people care about this kind of value approach? Well, basically because of these two guys more than anything else. So these are two professors at the University of Chicago. So that is Fama and French. So they won the Nobel Prize. So people obviously think pretty highly of them. And what they did is they came up with the three-factor model. So what they did is they went back and they looked at a lot of historic return data, and they tried to figure out, are there different factors that allow us to identify shares that do well and those that tend to outperform and those that don't. So they came up with these three different factors as they were going through there. So the factors: the size of the firm, book to market values, which is basically just a valuation technique. So they're looking at value there. And then, of course, they looked at the third factor is excess returns. Where do you get excess returns? And guess what they figured out? Well, they figured out that small cap stocks, so smaller companies, so remember, capitalization, market capitalization of a company is just the number of shares outstanding times the price. So smaller companies and companies that fell on the value side of things tended to outperform. So they came up with a three-factor model, and everyone thought, great, okay, well, then the important thing to do is we need to invest in small companies that are value oriented companies. And yeah, that's great. Worked out historically, but what has happened since the GFC? Well, none of this has worked. So what has outperformed since the GFC, particularly if we look at US stocks? Large cap growth stocks. So the question and why people are talking a lot about value investing is historically has worked better. It has not worked well since the GFC. What's happening? Is that outperformance by growth stocks going to continue? Are we going to see a rotation back into value? That's the question we're trying to answer today. And what are, of course, the implications on us as investors? So and this is the style box, by the way. So this is what I was talking about before. Probably should have put it on the first slide, but I had my Hotel California picture up there. We didn't want to displace that or distract from that. So yeah, we're looking at, and this is, so basically what this is showing a portfolio on our website, and it's just showing where the majority of that portfolio falls. We can also do that with an ETF, of course, or a fund, and you can see where it falls on this spectrum, this value to growth spectrum, or this large cap to small cap. So remember, Fama and French, looking back at their three-factor model, they would say the place to invest is here, right? Small cap value. Now, of course, as I said, what we're going to explore today is that hasn't been working. Why not? And what are the actual implications? All right, so let's talk a little bit about this idea that we are dividing up, and we're going to use the S&P 500, so the 500 biggest stocks in the US by market capitalization. We're going to use that as an example to talk about how are we going to divide up this universe of stocks into value stocks and growth stocks. So here's what we have. We've got the S&P 500, and these are all indices that are put out by Standard & Poor's. They have the S&P 500, of course. Then they have an S&P 500 value index. Then they have a growth index. So those are the three things that we are looking at. There are products that obviously track all of these. I don't believe right now we have an ETF in Australia where you can get the value versus growth of the S&P 500, but in the US you can. And we'll show some returns off of that in a second. All right, so what are we looking at? S&P 500. We've got this. We've got a couple different things that we're going to explore. We're going to look at yield. So that is dividend yield. So dividend yield is simply looking at dividend paid divided by the price. So of course, the yield can adjust as number one, prices go up or down, and also adjust if that dividend level changes. We're looking at price to book value. So basically what price to book value is we're looking at the balance sheet. So there's some technical adjustments we make, but really we're looking at assets minus liabilities. So at the end of the day, yeah, what's the company, what are the actual net assets that the company has? Price to earnings, trailing and forward. So we're looking at price divided by earnings. So trailing, of course, is stuff that's actually been reported. So that is historical data that's come out, that's in financial statements, and forward is, of course, what the estimates are. So analyst estimates for what the earnings will be into the future. All right, so let's look at these. So we've got, and a couple of things that come out, obviously, is if you kind of look at these, and we want to consider these all valuation measures in some way, relative valuation measures, you can see that the S&P 500 as a whole kind of sits right in between these two different value and growth indices that they have. And see in almost every single category, well, I guess in every single category, that S&P 500 is sitting right in the middle. So that's just an overview of kind of what we're talking about. We're talking about value and growth. Okay, let's dig in a little bit more. let's talk about what actually goes into these. So once again, these are the same indices that there are products, at least in the US, off of. We're looking at the value component and the growth component. So a couple different things we can look at is obviously you can see, and I won't go through all of these, but you can see the top 10 constituents in each one of these. And you can start to see some patterns coming out. So if we look over on the value side, look at some of the sectors that are involved in that. Financials, so generally banks fall into the value side of things. And then we move over to the right, you're seeing a lot of tech companies. So tech communication services involves a lot of companies that people would traditionally think were technology. So Facebook, Google, you can see those two Alphabet share classes. So yeah, kind of exactly what we'd expect it to be. And then that's reflected below in sectors as well. So you can see obviously 41%, close to 42% of the growth index is made up of information technology, or the information technology sector. Then the other side, we're seeing things that are more traditional value, so financials and healthcare and industrials, et cetera. So yeah, probably reflects exactly what you think. And also, as you start looking through some of these names on here, it's probably obvious why growth has done so well. Because of how some of these companies have performed and what you probably heard about them. All right, so let's look at why people have been recently talking about this. All right, this is obviously a very specific time frame, but if you go back to October, you go back to the 1st of October, you can see that values actually outperform. So what I did here is I took 2 ETFs in the US. So this IVE on the left is simply an ETF that tracks that S&P 500 value index. And if we go IVW, that is tracking the growth index. Now, this is not a big outperformance, but when we go back and look historically at what has happened since the GFC, you'll show that, hey, this has been pretty profound. And you can see right here, and we'll look at it, growth has actually come back. So there is a bigger gap between the performance of the two until, basically the last 3 months at the end of the day. So what does this mean? Well, this is a very short-term market return. So what should this mean as investors for us? Nothing. But a lot of people have been talking about it, and there's been a lot of commentary about it because growth has outperformed for so long. You've seen this persistent outperformance. Because it's outperformed for so long, people are now taking a look at and thinking, hey, is there a possibility that we are actually seeing a rotation back into value? And we'll get into some of the reasons around that for a second. But yeah, here's what's happened in the last 3 months. So we have seen a rebound for growth, represented here, this 5.54% return. Now, all these returns are in US dollars. They are not, these are US ETFs, so they are not translated back to Aussie dollars. So there is no currency translation here. But I just wanted to purely isolate just the returns of these particular styles of investing. So last 3 months, you saw this rebound. So value had been outperforming growth over that very specific time period from the 1st of October by more. All right. 5-year returns, you can see, big difference, right? 171% for growth versus value. So pretty impressive outperformance. But one of the reasons that people went back and started talking about this rotation into value and potentially being a thing is because what happened after the dot-com or during the dot-com bust. So this is a chart that's going back and looking at the period 2000 out to 2005, and you can see here that there was a significant outperformance by value. So it was represented by this IVE, right? So it was actually up 18%, where we had the growth index go down 24%. So why were people talking about this? Well, if we think about what happened before the dot-com bust, is there was a huge run-up in technology stocks. So the market overall was very expensive, but very specifically, a certain part of the market was very expensive. These same tech stocks took over and became bigger and bigger parts of the index, so bigger and bigger parts of the S&P 500. And then, of course, everything fell apart. So this is looking at the S&P 500, but remember the NASDAQ went down 79%. something like that. S&P 500 went down, particularly the growth portion went down, while value actually did okay. And so I think a lot of people are looking back at that time period in the dot-com bust and seeing that there are potentially parallels with what's happening now, because the same thing has happened. There's been a huge run-up in certain stocks, certain sectors. There's certainly been this notion that there is potentially a lot of speculation involved in the market, which we've all seen, what Jeremy Grantham would describe as crazy behavior going on. And I think a lot of people have looked back on what is a time period where there are parallels of what's happening now. And they looked back to that dot-com era. And the thought was, of course, okay, are we potentially going through the same thing? And we talked about this when we did how to value a share last week, but also remember that in many cases, growth companies are more sensitive to changes in interest rates, just because most of the value, remember when we're valuing shares, we're taking future cash flows. That's the value that we get out of shares. Because of a lot of those future cash flows and the growth is baked further into the future, just mathematically, when we're discounting that back, there can be a bigger impact from interest rates. So I think there was a lot of fear in the market. Well, fear is maybe the wrong word. There was a lot of speculation in the market that, okay, are we potentially going through the same thing? So we saw this certainly in February, where we had interest rates jump up a little bit with some of the inflation fears that have happened. We've seen it recently as well. Obviously, all of the inflation readings we're getting right now are elevated. And the question, of course, is, are they transitory, as everyone keeps saying they're going to be, and they're going to come back down? But I think the market is sitting there and, yeah, somewhat worried about, or somewhat suspecting that maybe the same thing could happen. Now, obviously, in the past 3 months, we've seen a bit of a rebound, but just wanted to provide a little perspective from a return standpoint. Okay, this data is a little bit old, but let's look at what our analysts actually think. So this goes back to the 30th of June, 2020. Now, remember, there's been a little bit of a rebound, but basically at this point, the market has gone up in both value and growth investing styles. But our analysts, of course, are going in and they are evaluating and calculating or estimating the fair value on everything within their coverage universe. And we can roll that fair value up into all sorts of different categories. So that fair value on individual stocks, we can roll it up into countries, we can roll it up into styles. So if we go back to June 30th, which was the last time I was able to pull this data, we looked at our internal indexes. So we've got a growth index, we've got a value index, then of course we've got the overall market index. And what we looked at is the price to fair value. Now remember, a price to fair value of 1 for a security, or of course for any sort of roll up of those, means that we think it's fairly valued. So our analysts believe it's fairly valued. Anything over 1, we believe is overvalued. Anything under 1, we believe is undervalued. So overall, if we went back and looked at June 30th, remember, about a year ago, a little over a year ago, we're seeing 21% overvalued for the growth index, 11% undervalued for value index, and then, 8% overall. So it is important to look at valuation, because just because, and we'll get into this in a little bit, just because somebody is paying more for growth does not mean that they're paying too much. So we'll get into that when we get into our little Warren Buffett section. All right, why has growth outperformed? So there's obviously a lot of reasons, but this has been one of the longest periods in history where growth has actually outperformed. So people are trying to figure out, okay, why did this happen? Traditionally, what we've seen is, if we go back to that Famine French model, traditionally what we've seen is we've seen value over the long term outperform. But what we've also seen is we've seen that there are rotations. And that's why this long period of outperformance by growth has people, a little bit curious why this has happened so much, because normally we've seen rotations, or rotations back into value. All right, so let's go through each one of these measures. So a guy by the name of John Reckenthaler, who is a market strategist in the US for Morningstar, wrote this article, which is a good article, I think. Couple months old at this point, but if you'd like it, just send me an email and I can send that along to you. But yeah, he went back and looked at why growth is outperformed, and he looked at these 4 different factors to try to explain outperformance. So yeah, we'll go through each one of them. So number one, the recent business results have been stronger. So why have they outperformed? Well, the companies have done better, is what he's saying on this first one. So what he went back and he looked at, once again, those two indices. So the large growth index, and then he looked at the value index. So he went back to 2015. And he looked at the companies in this large growth index, and they traded in 2015 at an average price to earnings ratio of 24.2 times their trailing earnings. Okay. Now, what happened since 2015? And remember, this article is a couple months old. What happened when he went back and looked at it? Well, he found that that multiple had increased to 45.2 times their trailing earnings. So that basically means when we looked at 2015, and I believe he wrote this in 2015, investors were willing to pay 87% more for growth than they were back in 2015. So, okay, that's interesting. So what happened? What caused that? Well, basically the index went up a lot. So the index went up 161% over that same time period. So what we can do is we can back out those numbers then, and we can figure out, okay, how much did these growth companies actually grow their earnings? Are their business results stronger? Well, they grew their earnings by 40%. So between 2015 through 2020, they grew their earnings by 40%. So what does that actually tell us? Well, it tells us that, hey, investors were willing to pay 87% more for 40% growth, right? So they are not growing as fast as the increase in multiples that people are willing to pay. So that's certainly one way to look. If we go back, he did the same thing. He looked at the Morningstar Small Value Index, once again, looking at these Fama and French models, to see what happened there. Well, basically, the price to earnings ratio fell over that same period from 15.6 to 14.6. Over that same time period, investors are actually willing to pay less for those value companies. And okay, what happened between that? Well, the index rose by 23%. And that means that we can go back and once again look at those earnings and see if those earnings actually matched that outperformance. So what did they gain? They gained 31%. So pretty interesting, right? So 31% small cap companies grew their earnings 31% over that time. Large cap growth companies grew their earnings 40%. So they grew slightly more, not that much, and investors were willing to pay a bunch more for those same earnings. So yeah, pretty interesting. It would imply, I think, and as John implied, that maybe this is not actually justified. So he did the same thing in each one of these things. I will send you that article, and if anyone wants it, you can go through it. But basically went through each one of these points and tried to look at, does this outperformance, is it actually justified, and found that no, it is not, except for, of course, this 0.4, they have become investor darlings, which is basically the indication that we saw when people are willing to pay a lot more for their earnings. All right, so this is all historic. Why does it even matter to you? What should you think about as an investor? Well, depends what kind of investor you are. So number one, if you are going out and you are buying a managed fund, for example, there are managers that, of course, have mandates, or managers who believe very strongly in one of these styles of investing. So that's certainly something that you can explore. You can see where your fund fits on that Morningstar style box. So that's certainly an approach you can take. But if you go back and buy individual stocks, let's think about some of the drivers of individual stocks and where this comes in. And we're going to talk a little bit about our friend Warren Buffett. All right. So the big question is Warren Buffett, who many people consider the quote unquote most famous value investor, is he even a value investor? So let's talk a little bit about Buffett's history. And then this will allow us to unlock sort of what we're actually doing as investors and what we're paying for, and what are the drivers of returns. All right. So if we go back and look at Buffett's history. So Buffett started out in the class with Benjamin Graham. So he went to Columbia Business School and he had read Ben Graham's book. and thought, okay, I want this guy. Well, after Harvard rejected him, which they probably regret now, decided, okay, well, the next best thing is I'm going to go to Columbia and I'm going to take Ben Graham's class. Now, Ben Graham, of course, is really professionalized the whole investment industry or the investment management industry. Literally wrote the textbook, Security Analysis, that was used in his class and sort of started out the whole discipline of investing. And then, of course, that turned into the Intelligent Investor, which is a little more, retail friendly than a giant textbook. So Buffett took this class, left his class, went back to Omaha, Nebraska, and started his own fund. And originally, was he a value investor? Absolutely. So Ben Graham was sort of very famous for not caring much about the companies. He didn't care what they did. He didn't really care about their business. All he did was look at the financial statements and said, okay, I'm going to find something that's ridiculously cheap and I'm going to buy it and I will diversify widely. And this is the approach that is going to lead to outperformance. Now, he, of course, was investing and really sort of came into his own after the stock market crash in 29, which led to the Great Depression. So guess what? It was a lot easier to find bargains. So if we went back to that slide and showed you the price to book value of the market in general, but also even the value side of the market, Ben Graham would probably roll over in his grave because he was trying to go out there and find stocks that actually had more net cash than they were selling, than they were actually trading for. So I think from a valuation perspective, he would be very shocked at what was going on now. But this is how Buffett invested. And so he invested in his partnership, the same value approach, up until 1969, where he basically gave up. So he sat there and he said, I don't really understand what's going on in the market. There had been a huge bull market during the 60s. It ran up to 1972, this quote unquote nifty 50 market. And Buffett just eventually figured out, okay, well, I'm trying to use this technique I learned from Ben Graham. It's just not working anymore because I actually can't find companies that meet any of this criteria. So he gave up one of these quote unquote cigar puff companies, trying to get the last puff out of a dying company. He bought this little textile mill called Berkshire Hathaway in New England, and he kept that as part of his own personal portfolio when he dissolved this partnership. And then, of course, Berkshire Hathaway started. Now, Buffett, over time, his approach to investing changed a lot. So people attribute this to all sorts of different things. Was it his friendship with Munger? Was it just the fact that the market evolved and he had to evolve his technique to come up with to keep up with it? Either way, as part of Berkshire, obviously invests in a number of publicly traded companies and just buys whole companies. Is he a value investor anymore? A lot of people would argue no. A lot of people would argue that he is, once again, very focused on valuation. And this is what we'll get into in a second. Very, very focused on valuation, but understands that we are not talking about just a pure, we're not just talking about a pure balance sheet valuation of a company. We're also talking about intangible assets. So things that can't actually be measured. So remember, we talked about this I think last Tuesday, maybe we talked about tangible assets and intangible assets. So I can measure the value of a tangible asset. So that's stuff that Ben Graham was really worried about. A factory is a tangible asset. Any assets you have sitting on your balance sheet that are real things, we all know what tangible means. That's a tangible asset. Intangible assets are things like brands, all the stuff that goes into Moats that we were talking about. So Buffett is still very focused on value, but he's now valuing things that, number one, you can't find on a balance sheet, that actually that take understanding business. So Buffett is a famous student of business, and that's what he really enjoys. So it's his understanding of the business, his understanding of their competitive advantages of the companies he wants to buy. And he also realized at the same time that you have to pay for quality. So sort of the famous example that's always brought up about him, especially with Munger, is See's Candy. He was buying this candy brand on the West Coast of the US and paid what for him was a shockingly high price for it. But ultimately he was buying the quality of the company. So that's Buffett. Here's a list of his 20 holdings, top 20 holdings. Now remember, Berkshire Hathaway owns a lot of private companies now. They buy companies outright. So these are just public holdings, publicly traded equities. But if we sit here and we go through his list, I think something like 9 of these actually fall into that S&P 500 growth index. So certainly if you go through and you can check off some of the names, Apple, Coke, et cetera, Moody's, those are companies that fall into that growth index. Whereas some of the more traditional value companies, namely banks, are on there. All right. So let's talk about what we can think about as investors when we're talking about value versus growth. So there are people that obviously feel very strongly about one or the other camps. I think it is really important, particularly as an individual investor, to have an intellectual framework that actually governs the approach that you take for investing, because that allows you to stick to it. But let's think about what we're doing. What are we doing if we're buying a growth company? So obviously we're willing to pay more, whatever measure we want to talk about. So whether that's earnings, whether that's book value, lower dividend yield, et cetera, we're willing to pay more for these companies. What are we paying for? We're paying for that growth. Now, the question, of course, is what you're paying for that growth reasonable? And that, of course, is very difficult to find out before you do it. But think about that. You are paying for growth. So really what you're paying for are expectations of the future that are very, very positive. And as investors, we need to remember that, and we did a podcast episode on this, we need to remember that expectations that are already built into a stock, the question is not how the company does on an absolute basis. The question is how that company does versus those expectations. So something that's really important to remember. So if everyone expects the earnings of a company to grow by 15% and it grows by 10%, well, that's, as an investor, that's most likely going to be a lot worse outcome for you than if everybody thought the company was going to lose money and they actually grew earnings 1%. So it is better to obviously outperform those expectations, those collective expectations of the market, which are what is actually setting the price, right? The price is an equilibrium between everyone's expectations. So just remember that with growth. If you're out there buying growth companies, that's great. But just remember those expectations are already baked in there, and make sure that you understand that, and you understand that, hey, once everybody has decided that a company is going to grow a lot and do very well, it probably needs to do better than that for you to actually outperform as an investor. Conversely, I think the problem on the value side, and that people have run into, is that purely looking at metrics and looking at companies just from things that we can see from financial statements and the ratios that we get off of them has not been very successful. So this rotation to value has not happened, namely because, in many cases, a lot of people talk about this has become more of a winner's market, that fewer companies they're continuing to grow bigger and bigger and bigger, and they're continuing to take more and more market share. And that, a lot of those companies are quote unquote investor darlings for a reason, because they're actually growing. All right, so we've got a couple of questions we can start to get into. So if you have questions, ask them. All right, so Sally says, are there any index funds that screen for value? Yeah, so you can certainly find, so the two examples I used were from the US, but there are a lot of different index funds that you can find. So basically, there are funds, there are factor funds at the end of the day. So we went through that famine French example. Those are just examples of factors. So they had a 3-factor model, but there are funds that in ETFs that go out there and that are passive, that are following indexes, but they're indexes that are governed by certain factors. So you can go look at quality factors, for example, which basically denote to value. And yeah, that's an approach you can take. The other thing, of course, is there are active managers that are value investors, and you can invest in those. All right, so Bill called me wonderfully human, which I guess is good. So thank you for that. just me screwing up all of these webinars is wonderfully human. Okay, so he's saying the way that he monitors growth versus value is he is looking at two different Vanguard funds. So he's looking at, diverse high growth Vanguard fund, so VVLU, and global value Vanguard. So there are all sorts of different ways, and the reason, so two ways that we can monitor sort of growth versus value is there are underlying indexes. So of course you can go and see that underlying index performance. So we've got Morningstar value and growth indexes. Certainly, as I showed you before, those two ETFs in the US that are based on the S&P 500, those are off of course, indexes put out by Standard & Poor's. So you can go look at how those indexes have performed. But yeah, you can certainly use as a proxy, which is what I did. You can use ETFs. So yeah, Bill, I think it's a great approach to sort of look at how both those different styles have performed. Okay, so Lisa's saying, does rotation to growth mean value companies find it harder to acquire shareholders and therefore private fundings? Yeah, well, okay, it depends. So remember that, yes, you can go out there and of course, come up with secondary issuances as a company if you want to continue to raise capital from the equity markets. So that's always something you can do. What it basically means is that if you were to do that because you have lower valuation levels, remember we looked at that example by Reckenthaler, because valuations levels are lower, that means it's more expensive basically for you to raise equity capital at the end of the day. So what you'll see a lot, and it's a smart thing to do, what you'll see a lot is that when companies are really outperforming and they are trading at a really, really high valuation level, they can do things like use their stock, issue stock to acquire other companies, for example. So yeah, you do want, if you are management, you do want the valuation levels to be higher because you can use that stock basically as currency. But in theory, if you're not raising money off of it, then yeah, you're okay as a value manager or as a management of a company that is a value company. Technically you're okay. It's more looking at what the business has done. But yeah, I think you'd rather be in some of those large cap growth stocks that have taken off. Okay, so the anonymous attendee is asking the question that always gets asked, which is fair. So saying, does Morningstar Australia site have info on US ETFs, or when would that info be made available? Okay, so yeah, good question. We're still trying to figure out exactly how to show that information. Yes, we do have that. So for instance, if you go set up a portfolio with ShareSite and you put a US ETF in there, you can actually go through and see our research. So it'll be pulled into your portfolio, and then you can read our research. So that's one way you can do it. What we're trying to figure out is a good approach to show US ETFs. And I know people have probably heard me say this before, but we've got other stuff going on too, is to show US ETFs without confusing people. Because the last thing that we want right now is for somebody to think that an ETF is trading on the local market and then realize later when they're trying to actually buy it that it's actually only trading in US markets, because you do have to trade it through different brokerages. Commissions are different. There's other factors that come into play. But yeah, what we'd ideally like to do is figure out a way that we can show you our research and data on US ETFs, UK ETFs, et cetera, and but just show it in a way that it's actually divided up so nobody gets confused about what can trade in Australia and what can't. And I know it probably sounds easy, but yeah, there's a couple other tech considerations involved in that. Okay. All right, so we've got a question, which I think maybe is more of a philosophical question, saying, can we consider growth as value? Yeah, so let's talk about this. There is certainly this notion that once again, if we go back to the whole Buffett, what we were talking about with Buffett. So where has he evolved to? Well, he's evolved to the fact where he understands, or says that he understands, he obviously understands, but talks about how you do have to pay more for quality. And you do have to pay more for a great company, and that's perfectly fine. The question, of course, with every single part of investing, the question is, how much should you pay for that? So I wouldn't worry necessarily if you are paying more from a valuation standpoint for a great company than a company that is not as good. Remember, when we talk about great companies, we're talking about moats, sustainable competitive advantages. I don't think that is an issue, but I think the universal question with everything with investing is, how much should you pay? I think people can fall. I think people can fall into the trap where they are only looking at things like relative valuation techniques, and they're only comparing, okay, this company is expensive. And what we always talk about on this when we're looking at these relative valuation techniques is that if a company is expensive or if a company is cheap, okay, well, that's great. We need to understand why. And as investors, we need to figure out, okay, is the reason that one company is cheaper than the other, number one, do we agree with it? And number two, should it be cheaper because of that? So, the example that I use a lot is Jeremy Siegel wrote this book, Future for Investors. And he looked at, I know I've said this a couple of times, but he looked at the top performing stock between, I think when the book came out, it was like 1926 into like the mid 90s, and it was Philip Morris Tobacco Company. And the reason, and that's reinvesting dividends. And the reason for that is the market had such low expectations for the company the entire time that it was always trading really cheaply. So it had a high dividend yield. He was taking those dividends, reinvesting them when he was doing this model to figure out performance. And at the end of the day, that mattered. Expectations were really low. Everybody thought that the companies were potentially going to go out of business. They thought there were going to be lawsuits from governments and individuals and everything else that put them out of business. It didn't happen. So basically what they did is they outperformed really low expectations. I think I would think more about, I guess, expectations than anything else. And think about, okay, if you are paying more for a growth company, what is the expectation that's actually going to happen with this company? And do you have a thesis where you think something different will? And this, by the way, when we talk about value versus growth and we talk about looking at relative valuation techniques, our analysts are doing the opposite, right? So they're going in there and they're actually analyzing and trying to take all these factors into consideration when they build out these discounted cash flow models, which of course include all of this. So their valuations are trying to cut through any of this like relative valuation, what should you pay a lot for, what shouldn't. Okay, so we've got a good question. Can any of the FANG stocks be regarded as value companies? All right. So of course, when we're talking about FANG stocks, we're talking about, and the whole reason all this sort of FANG stuff came up is because we've seen sort of persistent outperformance by certain companies. And that of course is a lot of the companies that are the FANG companies. So Facebook and Alphabet, which is Google and Amazon. So are they considered value companies? No, I think all of them fall into what we would consider growth. The question with them, of course, is what you're paying. Is what you're paying appropriate for the fact that a lot of them are great companies, and they have great companies that are continuing to grow very fast. They have really high profit margins. They generate a ton of cash. They're scalable. So all these factors, when we do these things on tech, all these factors that make them great companies, the question, of course, is how much do you pay for that? So I don't think there's a lot of arguments out there on whether these companies are great or not. I think the arguments, of course, is what are you paying? And this is, and I guess we can spend a minute on this since we're ahead of schedule. This is where we talked about different industries typically fall into different buckets in terms of value versus growth. So technology stocks, yes, tend to go into this growth category, as in investors will pay more for them. They are growing faster. But why is that? Well, because they have really good business models. A lot of them are really, really scalable, basically meaning that you do not need to invest a lot, invest a lot of capital to grow. Once you have a product, think about Facebook. Like, yes, while you're scaling and getting more and more people on that platform, yeah, you'll have to pay some money. You'll have to grow the workforce a little bit, things like that, but nothing like an old-time industrial company where you would have to build new factories and keep investing capital. So they are great companies. And because of that, and because they're so scalable, you get their margins are great. They're able to convert revenue into cash. They all generally have huge cash balances. So they are good companies. So yeah, that's kind of the universal question, is not what's more expensive or not, it's whether it's worth it. Okay. Okay, so Eric has a really good question. So Eric's saying, isn't it more difficult to determine the moats for growth stocks versus value stocks? As examples, Afterpay and Tesla is difficult to work out their future competitive advantage. Okay, there is this school of thought, of course, that yes, if you are, I wouldn't necessarily call it growth, although they are mostly growth, that as an investor, an industry that changes significantly is of course harder to figure out the dynamics in that industry. So sometimes when we're talking about really, really cutting edge technology, it is a lot more difficult for anyone to work out. And when the rate of change in that industry is really, really high, it's more difficult to figure out, okay, what is the competitive advantage of any one of these companies against each other, and will those be able to be maintained? So yeah, I think in both those cases. So if we look at Afterpay and Tesla, and this is my own personal opinion, but it's also Morningstar's opinion about some of them. So yeah, I think Tesla, if you go back and you look at Tesla, I'm just confirming this while I talk about this. I think we certainly think that Tesla is a great company. We just think it's way too expensive. And so, that's one case where, and I believe we have a moat on it. So we've got a moat on, oh, that's not Tesla. I can't spell. That was Telstra. Telstra is a very different company than Tesla. Let me just confirm that I believe it has a moat. So let me just confirm that. I have unsurprisingly not memorized every one of our moats. So Tesla has a moat. We just think it's really, really expensive compared to what we pay. Afterpay is different. So Afterpay is an interesting one. We did a podcast on Afterpay and the whole buy now, pay later space, and our analysts does not believe that either one warrants a moat. Basically saying there's not much competition, and I think it's been interesting there's not many barriers to new competitors, which I think is interesting given what's happened in the past week and a half. Right, we've seen announcements that PayPal has launched their sort of whatever quad pay or whatever the hell they're calling it, these 4 payment things, so basically doing the same thing as Afterpay. So PayPal, and then Apple came out and said they were going to do it as well. And the point is, and I think the point of our analysts we're making is that, okay, there is this space. It's obviously growing very quickly. It's going to attract a lot of competitors. Are there sustainable competitive advantages from a company like Afterpay? And I think our analyst view is in Australia, maybe. Not so much outside of Australia, where companies like PayPal and Apple, as well as the other just sort of pure buy now, pay later competitors are going to do well. Because once again, competition, and the reason we think about moats, competition means what are you going to do? You're going to have to cut prices potentially to compete, or you're just going to give up market share, or potentially both. So yeah, so I don't know. I obviously I talked about the two examples you used, Eric. But yeah, I think in any sort of fast-moving, fast-changing industry, it is harder to figure out the competitive advantages out there. So it is a good point. Okay, so Lisa of Alpaca fame, I forgot to say that before. Please discuss the pros and cons of investing in tech via direct stocks in the U.S. market versus investing them via a locally offered ETF. Yeah, so listen, the advantages and disadvantages. So obviously, it depends on what you're paying in brokerage in both of these. So we'll sort of start with some of the direct costs. So there are, of course, brokers. So what, Superhero, Stake, where you can buy U.S. stocks for quote unquote nothing. Now they gouge you on the FX and in other fees, so that's an important thing to take into account. But yeah, so trading cost is one thing. Obviously, to build a diversified portfolio is a lot easier with an ETF because it's one trade. Direct shares, it obviously depends upon what shares you invest in. What I would say is what we've seen a lot with ETFs recently is depending upon which ETFs you invest in, is we have seen huge distributions. And a lot of these distributions are made up of capital gains. So it's one of the problems that you face as an investor in an ETF or a fund, that you have no control over those capital gains. So the capital gains are distributed to you in a distribution. With individual stocks, you get to at least control that. But yeah, it's a lot more expensive from a transaction standpoint to build a diversified portfolio. You also have to pick the right ones, which it's very difficult to outperform the market. Now, of course, a lot of the ETFs that people are using right now are so narrowly focused. So all these ETFs, so whether it's FANG, ACDC, all these thematic ETFs, which we think very, very, very poorly about. And Morningstar, they're really, really narrowly focused. So hey, potentially you're not diversifying that much by going into them. I've got a question about Hamish Douglas. All right, so Hamish Douglas, Bill's asking, Hamish Douglas, and of course Magellan, considers Netflix to be such a great growth model that provides good value for his funds. He's not invested at Apple, for example. Yeah, so Hamish, so it's hard for me, obviously, to comment. We think very highly of Hamish, I'll say that, and we think very highly of Magellan's funds. So certainly Magellan Global and the various iterations of that do have a gold rating from us. So yeah, we think pretty highly of Hamish. Interesting story. On a side note, Will, since you're listening, there's an article in the AFR that came out last night that Hamish said he thinks crypto is going to zero, which I thought was a bold call by him. But yeah, so I think if we sort of look at Hamish and look at some of the companies that he's investing in, yeah, a lot of these companies are certainly companies that are kind of traditionally expensive if we look at different metrics. So yeah, and a lot of technology companies. So yeah, that's just an example of obviously trying to balance between what you're paying for growth and what you're going to get out of this company. Now people are sending me articles. Well, thank you, Mike. I can't read it right now. I don't know if that's the crypto article where he said it was going to zero. Hopefully Will's not pulling his hair out. Although since there's nowhere to actually get your hair cut now, maybe pulling your hair out is appropriate. So yeah, we've got a question from Dennis saying, how much of a premium you should consider for quality companies? Yeah, listen, it's obviously very difficult for me to answer that. I think the big thing is, of course, doing a fundamental analysis of the company like our analysts do can be a jumping off point. So, what I like, and I know I've said this before, and I'm obviously a little biased, what I do like about the research reports our analysts put out is they'll generally spell out what they think is going to happen. And that gives you an opportunity to sit there and look at their assumptions that go into these models. So obviously they are trying to estimate what's going to happen in the future, and look at that and come up with your own conclusions around what you think is going to happen, and then you can sort of see how that goes into our valuations. Okay, so Mike's saying that article that he sent, yeah, is the crypto article, which is interesting. Yeah, so we've got yeah, so Mike's also asking about funds and ETFs, and he's saying Regal, so I don't exactly know what has happened there, but have paid big distributions. Yeah, so what has happened? So particularly, so let's take FANG, for example. So FANG is an ETF that has 10 holdings in it. And if you go into the website and read the criteria, they say it's tracking an index. I mean, fair enough. It's not really an index. It is a committee of people that's picking what goes in there. So if you go and read what their criteria is to actually choose what goes in there, it's like ridiculous. Don't quote me on this, but it's something to the effect of, we invest in popular companies. So it's like, we invest in companies that are in the technology space and communications that are really popular with investors and show momentum, right? So they invest in popular companies. You know, I mean, I guess that's an approach. I've always thought it's a little bit strange. So you're basically saying that whatever momentum as a factor will continue. But they invest in 10 companies, and then they rebalance this thing to put equal weight into these 10 companies periodically. So I don't remember if it's quarterly or if it's half yearly, but either way, they rebalance these things, which means you sell all the winners and then buy all of the either losers or ones that have underperformed. So you are just like, it's this capital gains distribution machine at the end of the day. As long as the market's doing what it's doing now and still going up, it's just this giant capital gains distribution machine. And I've seen on all these message boards that people are like all excited because they're getting these big distributions from like FANG, for example. And I can't figure out why they're excited, because they're not dividends. None of these companies, like most of the companies in FANG, don't pay dividends. So this is not income you're making. You are just getting a tax bill that you're going to have to pay. And you've basically invested in this thing that will perpetually generate those tax bills. So I think it's interesting. Like, and if of course the market goes down, right, when if you're an income investor and you really want those distributions, the actual income, when the market goes down, you won't get any because they're not generating any real distributions. They're all capital gains distributions. Anyway, that's my that's my little bit of a rant. So Mike is asking, can you blend both value and growth in one ETF? Yeah, absolutely. Right. So, you know, one way is just buying the whole market. Right. So if we look at those two ETFs that we looked at in the US, the value, the S&P 500 value and the S&P 500 growth, you want both in one, you just buy the S&P 500. Now, one important thing to note, and I know I've said this before, is remember that in a market capitalization driven index, so that means bigger companies make up a bigger part of the index. Bigger companies is driven, yes, by shares outstanding, but it's also driven by price. So if a company does really well and continues to do really well, it will make up a bigger and bigger part of the index. So if we have long periods of outperformance, we are going to see whatever companies are outperforming, they will make up more of the index. And it's kind of the problem that we always run into. Like financials were doing really well until the GFC. And right, then they all did terribly. Tech stocks did really well until the dot-com bust. So in lead ups, so sometimes when bubbles are forming and you have these long-standing bull markets that particularly are narrowly focused, which is what we've had now in technology, all of a sudden the index is made up more and more of this very expensive portion of it. And we've seen that with the S&P 500, that all of a sudden when it plummets, if that particular sector plummets, it pulls the whole index down. So even though you do get everything, it's always going to be more oriented to what's doing well. And in Australia, if we think about Australia, so what are we getting if we buy the ASX 200? Well, we're getting banks and we're getting CSL and we're getting resource companies, right? So if there's a situation where we see resource plunging and banks not doing well, we're going to do really poorly as index investors in Australia. Same thing in the US around technology. Okay, so James is asking, will value stocks increase in performance as interest rates increase? A lot of people think so. And we got this other question from Justin saying, can you discuss the impact of higher inflation on value versus growth? So higher inflation is likely at some point to lead to higher interest rates. Many people believe that in a interest rate environment that is increasing, when we're getting increasing interest rates, that could be a signal that value is going to outperform. And why, once again, sort of mathematically, that if we have a bunch of growth baked into the future, and we are discounting that back by something that involves interest rates, then the lower the discount, the more that future growth is worth. So the growth that's out years and years and years and years. Whereas if interest rates are higher and we are discounting by a higher amount, that future growth is worth less. Potentially cash flows that come closer, not potentially, cash flows that come closer to today are going to be worth more. So yes, there is certainly a lot of people, and there's a lot of things that would happen if inflation goes up and interest rates go up. There's a lot of other factors, but people think, yeah, all things being equal, that value could outperform. And remember when we went back and we looked at that .com era, what one of the things that sort of drove, obviously valuation levels are really high, but one of the things that actually drove the beginning of that .com crash was higher interest rates. So basically they were very nervous. So Greenspan in the US is very nervous about Y2K. We were going to wake up on January 1st, 2000, none of our computers worked. And so because of that, interest rates were kept low. They started raising them after. So when all the computers worked, the Fed started raising interest rates. They wanted to do that anyway to sort of dampen the market and this quote unquote irrational exuberance. And that may have triggered that fall. Okay, so we made it to 201. Anyway, sorry about the beginning of that thing. Thursday, Will be back here, in a COVID safe way. So we will not have me screwing this up by turning it off or turning it on at the wrong time. But anyway, thank you guys for joining. If anyone has any questions, you can email me, mark.lamonica1@morningstar.com.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.